Our matrix channel lines are saying that the market is up against an important resistance level for swing traders, and yet we still expect it will break above these levels, and probably so by the end of January, early February. Today is January 17th after the market closed, and we're discussing how these matrix lines have been incredibly important in the past and have been reliable in terms of giving us an idea about when the market is weak and when it's strong. At the moment, the market is behaving fairly strong. You'll notice that in this chart, this is the intermediate term scale. It ran up to this 48.31 level, which is where the matrix line is. This is on the S&P futures. And it hit it, came down off it, hit it, came down off it. And showing the type of behavior that it did, on top of which the 20-bar moving average is still up and the market is still above it. And today's action actually could have been a two-wave of the rally that started on January 5th, completing the two-wave, indicating that the market should start being bullish again starting tomorrow, the 18th. It conceivably could go up until the end of the month or early February. And then we expected the correction in until mid-February to be the bottom of whatever kind of correction it comes up with. Now, on this larger picture, on this larger scale, you see also major matrix channel lines, and this is now on the S&P cash. And you can see how in 2020, the market hit the lines and came shooting back down to the low in March of 2020. Then it broke above those lines, but it had a real big fight in order to get through it. And then it rallied immediately right up to the all-time highs at the upper lines. And there's a blue and a yellow line there, and they're both important. Right at the moment, the blue and the yellow lines are still not having been exceeded on the cash market, and the upper one is 49.08. So if we close above that a couple of days in a row, then the market has potentially done something meaningful and conceivably could go a lot higher. On the intermediate term level, the first chart I showed you, if it breaks above this 48.31 for closing on a couple of days in a row, above that, it would also have probably reached the 48.40, which was the high so far. It's also showing the potential to run conceivably much higher. It hasn't done it yet. We expect it will. We expect things to get more bullish starting tomorrow, and that we're likely to see these lines broken. But it's important to know what's stopping the market. It's not just the all-time highs that are being retested. There's something intrinsically meaningful. The all-time highs themselves were stopped cold by the matrix back in 2022. So there's an internal geometry in the market, a hidden geometry that's right now on the edge, it's on the fringe. And if the market can continue to not go down, or at least go sideways, it shows tremendous strength in the face of the level of resistance that it's right in front of. Just to remind you that we're having a Trade Forecast Mastery Masterclass starting the 21st of January. Now, because there are multiple short-term cycles in the market, and the mix of those cycles isn't always identical to the last time they came together. So you have a little bit of a quantum mechanical effect here with a certain amount of probability involved in any decision. And we've said before that we're expecting a low around January 31st, but the 24-year cycle is more of an exaggerated downside. What we're thinking is kind of a muted sideways pattern until after the early February high, and then it comes down into mid to late February before going up strongly, which is more similar to the 7-year cycle, which is occurring in 2017.